Hi, welcome to this video on maximum prices. So we're going to look at what maximum prices are, why the government might want to impose them, what they look like on a graph, what the consequences of imposing them might be, an overall evaluation of the policy before leaving you with some further questions for thought. So firstly, what is a maximum price? Well, first and foremost, it's an example of government intervention into a market. It's a legal limit on the price of a good, so not exactly setting the price. Prices are allowed to fall below a maximum, but will normally be set below the current market equilibrium. So in effect, at least in the short term, it probably is setting the price. So why impose a maximum price? Well, essentially you want to make the good more affordable, but there are two main reasons you might want to do this. So a product could be a merit good, or you may want to allow certain groups to access the product. So a merit good is one that the government feels that people should consume more of, or to a certain level, and that if left to the market it would be underconsumed. And there may be positive externalities involved. For example, there are rent controls in New York because the authorities there don't want poorer residents to be priced out of the city and think it's healthy that society is more mixed in terms of income levels. Before the 2015 general election, Ed Miliband, the leader of the Labour Party, proposed a price freeze on energy companies. Similar to a maximum price, not quite the same, as you don't want what's essentially a basic necessity, that's the ability to heat your home, to become unaffordable. Alternatively, you may want to allow certain groups access to a product, and it might even be a private company creating what's essentially a maximum price. So imagine you're pricing tickets for a concert. You could probably sell out your venue at an extremely high price if you have a good enough band. But you'd probably want to have a large number of tickets on sale below this equilibrium price. You'd be conscious of not pricing out the true fans. These are people who increase your social media profile, buy lots and lots of merchandise, and you'll quickly let the world know when the band sells out by overpricing tickets. You might want to think about whether this is price discrimination. Perhaps this is just profit maximization in the long run. Think about those questions. So let's look at an example. So here we have a normal market with equilibrium where demand meets supply at P1 and Q1. I'm going to add example numbers that will come in handy later. So the industry is producing 850 units for a price of £20 each. And from that, you should be able to work out the total revenue. So what happens if a government adds a maximum price above the equilibrium? This is essentially the government saying to firms, don't sell above £22. The sellers will turn around to the government and say, okay, but we were never going to. So there'll be no effect. So to have any effect, the maximum price has to be set below the equilibrium. At this price, we're at a disequilibrium. Demand does not equal supply. We have QS2 supplied and QD2 demanded. This means that we have excess demand. Now, how can we show excess demand on this diagram? Well, as economists, we love shading areas. Quite often these areas will be triangles, and here we have an area begging to be shaded, but this is a massive red herring. This area is completely meaningless. What we need to look at is the difference between quantity demanded and supplied at the maximum price. So if we have 1,000 units demanded and 700 units supplied, then we have an excess demand of 300 units. It's purely that distance QD2 minus QS2. But I really want to shade something. Well, look here to the left. You'll be familiar with the consumer surplus and producer surplus. These are areas of happiness that the market produces over and above the resource cost that goes into it. You could say that the combined area is a total happiness or community surplus. So equilibrium, where demand meets supply in competitive markets, is good because this quantity maximizes that surplus. Here you can see that output actually stops short of the equilibrium quantity at QS. So we're missing out on some of that total surplus. That is happiness gone that nobody's benefiting from. So we can call this a deadweight loss. So whenever you evaluate something that's a success or not, you need to know the government objectives. The government want a lower price. They probably want to price people into the market and make the product more affordable. But look, fewer people are consuming the good. It's not good if we have a merit good. And then let's consider what excess demand looks like. In our example, we have 300 units more demanded than supplied, so the likely outcome is queuing. That might involve physical queuing or joining a waiting list. Consider also that we may well have a black market or shadow market forming. Supply has been restricted to 700. So if you have one of the products in question, how much could you sell it for? So I showed you that earlier. So how does this square with the government objective of making a product more affordable? Also, this industry is less profitable for suppliers, so they'll invest less in it. You can relate this to the marginal efficiency of capital in macro, where businesses compare rates of return to interest rates for a given level of risk. So, for example, a criticism of rent control in New York is a lack of upkeep of rented properties. But couldn't you argue that suppliers could in fact be making more money if a black market forms? After all, the total revenue used to be this much, and now it's this much. The total revenue after the price change might be higher depending on the price elasticity of demand. Even if not, with less produced, total costs will be lower, and so profits higher. However, often it won't be the suppliers who make the markup in the black market, in which case this chunk of the second revenue block is going to middlemen, for example, ticket touts. We could say, though, that because there's a deadweight welfare loss, this policy is therefore unambiguously bad overall. But if we have a merit good, government may have moral or redistributive criteria that they believe trumps efficiency. For example, in New York, they may think that lower quality and less available rented accommodation is a price worth paying to avoid ghettoization in areas. They could question whether a maximum price rather than a general subsidy or targeted vouchers is the best way of achieving these goals. Also, what about elasticity? Let's say supply was perfectly inelastic. There we go. Now the deadweight loss disappears, although there's still a shortage. Evaluate then the extent to which supply is likely to be inelastic, for example for housing, ticket prices, and so on. Considering class or with a friend, if supply is inelastic now in the short run, does that also mean it'll be inelastic in the long run? In which situations would it be, and in which situations won't it be? Now let's consider the case where we have a monopoly. You remember that demand is the average revenue curve and marginal revenue is twice as steep as average revenue. We're assuming that we're giving what was a competitive industry a single owner for comparison purposes. Profit maximisation occurs where MC equals MR, and they'll charge a monopoly price of £22 in this example. Now let's change the numbers to show a different industry. Let's call it electricity retail. The monopoly is charging 10p per kilowatt hour, and had the industry been competitive, the price charged would have been 8p per kilowatt hour. So let's see what happens when the government imposes a maximum price here. Let's say the government put a maximum price of 9p per kilowatt hour on the industry. The maximum price becomes both the average revenue and the marginal revenue until it meets the original average revenue curve. Each time the monopoly sells one more kilowatt hour, it gets 9p. So on average it gets 9p, and each extra unit gives it 9p, so 9p is both the average revenue and the marginal revenue. Then, when we run out of buyers at 9p, we must go back onto the original demand curve and also the original marginal revenue curve at that quantity that goes with it. As an example, let's say we're selling 250 terawatt hours at 9p per kilowatt hour, and we wanted to sell one more terawatt hour, which is actually a relatively big increase. Our original revenue was 22.5 billion, and after selling the extra output, it's 22.47 billion. So our marginal revenue is minus 30 million, which would actually put us on the negative bit of the marginal revenue curve. So you can see there's suddenly a big drop down to the marginal revenue curve. So where will the monopoly produce? Well, MC equals MR now is where it'll produce. Output's risen from QM to QP max. And you'll remember our surpluses and the deadweight loss caused this time by the monopoly. Well, now we can see that the deadweight loss is reduced. In fact, had the maximum price been set at 8p, there would have been no deadweight loss and we would have had achieved an allocatively efficient outcome from a monopolised industry. Of course, as the maximum price falls below 8p, the monopoly would start to reduce output again and the deadweight loss would start to increase. The other thing to note is that we haven't drawn the average cost curve on this diagram, so we can't see profits, but they will certainly have fallen for the monopoly. A fall in a company's return in an industry logically should reduce their investment in the industry. So might this be an unintended consequence of this policy? In a market for rented accommodation, a landlord might let the properties become run down. Finally, for overall evaluation of a maximum price in a certain situation, consider the following. What are the goals of the government? How does the maximum price meet those goals in terms of efficiency, effectiveness, and equity? What is the state of the market? What are the elasticities likely to be in the short run and the long run? Remember, an initial outcome may not persist over time as economic actors start to adjust to the imposed change. And how severe is the maximum price? Maximum price above the equilibrium has no effect, but the further you get away from the equilibrium below it, the greater the effects will be. So I'll leave you with some final questions for thought and discussion. Remember, the answers to these questions will vary with different situations and the markets you're considering. So is supply generally inelastic in markets where maximum prices tend to be used? Is a maximum price a good way of dealing with a particular problem? Is a maximum price the best way of dealing with a particular problem? And if you're going to use a maximum price, how do you know what it should be? So I hope you found this explanation useful. That's all for now. Thank you very much.